much, everyone, for Thank you so much, everyone, for joining. This is our first investment opportunity for real estate, which we are super excited to partner with Sphere Investments on. I'll give it a minute before. Let's give it another minute because I know a lot of people have registered for this call, so I want to make sure we give opportunity for people to join in. And then I will just introduce the Sphere team who are with us here today. And then we go from there. But while we are waiting, I'm going to go ahead and share our disclaimer. Before we begin, I would like to remind everyone of the following information. PropelX is a funding platform, not a broker-dealer. A syndicate, if formed, will be managed by Plank Fund Management Corporation, a Nevada-registered venture capital firm. Private investments are highly illiquid and risky and not suitable for all investors. Past performance is not indicative of future results. You should speak with your financial advisor, accountant, and/or attorney when evaluating private offerings. Neither PropelX nor Plank Fund Management nor any of its affiliates makes any recommendations or provides advice about investments. The information you will hear today may make forward-looking statements about investments which have not been reviewed by PropelX or Plank Fund Management Corporation. You should not rely on these statements but should carefully evaluate the offering materials in assessing any private investment opportunity, including a complete set of risk factors. With that, I am excited to welcome Sphere Investments today. I am excited about our partnership. So Sphere Investments will talk about themselves, but what I'm so excited about is their track record. As you know, we at PropelX, we pride ourselves on curating high quality opportunities. And in that vein, we have partnered with Sphere Investments, who you see on the screen with me today. Sphere Investments is led by Didier Choukron, who is here, and also he is supported on his team by Esther as well as Dharma, who are both here. I'll let them give their own introduction in a minute, but before I do that, for those that are new, I'm going to share my screen and walk you through the investment process. So here we go. All right. Here we are. Can everyone see my screen? I believe you can. So as you know, we've launched real estate as a new offering. We are super excited about it because these are income generating properties. And given the frauds that we've had in the market, it seemed reasonable and it seemed meaningful to offer high quality income generating opportunities with low or small short holding periods. And that is what we've done with, we've launched with Sphere. Sphere manages over $1 billion in assets. Sphere is headquartered in Miami. They manage over $1 billion in assets. They've invested, which are invested in 39 assets across 15 states. Sphere has been operational since 2011. Since then, their annual cash yield on average has been about 10.35%, which means that these are cash yielding, like I said, income generating properties. So 10.35% on average since then. And they've had 12 exits, and the average IRR across these exits, which is realized, is about 24%. So more details about Sphere will be forthcoming. I'll let them introduce themselves, but I wanted to share this because this just speaks to the quality of the team that will be managing these assets. So this is our page. You can access this through the PropelX website, and we have a special page for this, real estate. Both of these are 506C opportunities, which means there is a verification process for investors. We are advertising these broadly. There are two investment opportunities. I'll go through one, and then it's the same process for the other. So the page is here, which is the Boynton Beach property. This is based in Palm Beach, Palm Springs. Sorry, apologies. I will let Didier and his team talk more about it, but you can learn more about this property by going to this page, as usual. There is a link to review the investment process, which we provided for your convenience. You can schedule a call with us or the Sphere team to discuss this opportunity. A little bit of a description of the opportunity, what we're expecting in terms of yield as well as the eventual exit, investment structure, fees, etc., etc. As usual, the risks, and then here's some documents, and finally, here's the terms of the raise. If these make sense to you, you can pledge your interest by clicking that button there. Sorry, I had started the process, but you would put in your investment amount. The minimum is $50,000 for the Boynton Beach property and $100,000 for the fund. And then you can just, it's an automated process from there. So with that, I am going to stop the share for a minute, and I would love to have Sphere introduce themselves. So Didier, why don't you introduce yourself, followed by Esther as well as Dharma?
Thank you, Swati, and welcome everyone. It's a great pleasure and honor for us to share this time with PropelX. We are also very excited about the opportunity to offer those type of investment to individual investors. In the past, as Swati know, we have been working exclusively with institutional investors, and we have tried over the years to diversify our source of capital, and we think that this is an incredible opportunity, not only for us, but also for investors like you to have access to what we think are great opportunities. Before I present quickly Sphere, maybe I will ask ST and Dharma to introduce themselves, and then I will say a few words about our company.
Sure. I'm Esther Egozi-Shakroon. I'm acting as Chief Operating Officer today. I joined Sphere years ago as Chief Financial Officer, and I'm very happy today to be running the global operations for the group. To echo Didier's words about our excitement in reaching out and attaining a different group of investors. We're all very excited, and we hope we can succeed because we see this as an excellent opportunity to tap into different markets for us. So we hope to next time have the opportunity to meet face to face and try to engender a more personal relationship, which is what we're used to. But for the time being, we hope that what we're going to be presenting today will incite you to want to take this a step further. So thank you for your time, and we hope that this will garner the necessary interest to move forward, hopefully.
Yes.
Yeah, we would love to see each and every one of you in our office at some point. We're not very far, right here in Miami. So my name is Dharma Raj Sunta. I'm the Managing Director, Strategic Partnerships and Medical Affairs for Sphere Investments. I'm a physician trained in the UK and moved to the US to complete my focus and concentration in real estate and finance. So I work with our team here to identify opportunities in healthcare real estate and building relationships with our tenants and operating partners and also investors like yourselves. So looking forward to working with PropelX and democratizing healthcare real estate for retail investors like yourself, like myself, and seeing how we can work together going forward into the future. Thank you for joining us.
Thank you, ST and Dharma. So on Sphere, before we talk about the opportunities, the company was started indeed in 2010. The first acquisition was in 2011. And we tried to create an entity that would change the way real estate investment are done. We wanted to focus on exclusively on the sector where we could bring more to the tenants than just the space and create a value proposition that would have many dimensions. To do that, we decided to only hire people that came from the real estate, but also the healthcare industry. So Dharma is a physician, our CIO is a physician. Many of our colleagues here are public health experts, and we have also a lot of data scientists. So the physician roots is extremely important, or the clinical root is important. We also are very keen in trying to understand every aspect of our investment. So we have built an incredibly sophisticated data platform, which really inform all of our strategy and help us to make the right decisions. And the third aspect of the company is a verticality. We are fully integrated from acquisitions, originations to asset management. So we don't surrender any aspect, which is important for us, of being sure that we can have control over the entire chain on the investment. 2011 was the first investment. We started the first, I would say, 7 years of our company by creating opportunities where the principal of the entity had at least 50% of the equity. And we'll talk about the core, but we own these assets since 2018, and we have the principal have 50% of the equity. So we're not the typical real estate company that has less than 2 or 3% equity and really use third-party capital to grow and generally focus on fees rather than appreciation. So that was really the dynamic when we created Sphere, which was known, by the way, in the past as Flagler Healthcare Investment. We changed the name in 2024, and I can get into this at a later stage. But really, that was a core model of the company. And in 2018, we had a lot of institutional investors coming to us, wanted to invest with us. So we decided to adapt the model, but keeping a principal mentality. So we always have a minimum of 20% equity in every fund that we have created with large institutions, or in every large portfolio that we have acquired. So that's really the I would say the essence of the company. We have had great success in providing stable return to all of our investors in excess of 10% in terms of yield. These are distributed on a quarterly basis. And we have had also the chance to exit some of the properties, so realize the entire cycle and generated very solid IRRs. We mentioned the average of 24 distributed in terms of IRRs. The range is extremely narrow. We don't have outliers. This is not an average that is not.
It's me, I think.
So that's
Sorry.
That's about.
Yes.
I think someone is.
Yeah, could you just mute
Mhm.
yourself? Yeah, thank you. Wow.
That's I think what I wanted to convey about. I think one of the person on,
Participants.
yeah, is one of the participants is not on mute.
Si tu cliques, il y en a
I-
d'autres. Yeah, right.
All right, keep going, please. Well,
So maybe Swati, we can talk about these two opportunities, and we would be very happy to respond to any questions on the company if there are any additional questions. So regarding the two opportunities, so we tried to make sure that we are starting this partnership with great opportunities, and we wanted to provide a sense of the potential diversifications, because we know that investors have appetite for different type of transactions. So we decided to choose one asset that obviously we control today and know very well. This is very tangible in the sense that all of the data in terms of the tenancy, the cash flow, the history is well known to us. And we believe that this will provide a very concrete path toward a visibility of what this transactions could generate for investors. And the other one, and we'll talk about it after, is a fund which provides diversifications and probably higher potential in terms of IRRs. But let's talk about this asset. So we have acquired this asset in the very industrial fashion of creating value. We are known, as I mentioned, because of our data, to have the ability to understand the needs. And what we did in this property located in Palm Beach, very close to our base here in Miami, we have identified the need for a very comprehensive orthopedic center of excellence. So we identify one of the most prominent orthopedic practice in South Florida. Um, they had at the origin several locations. We went to that particular practice and we decided to work with them in order to create an ecosystem with rheumatologists, with endocrinologists that could take care of patients in general with diabetes. We went to see the other main subspecialty, and we jointly created this ecosystem with those three main practices under rheumatology and orthopedic. And we identify an empty building. So the building that you see was empty. It was built in 2012. We fully refurbished the building, customized for the need of those three tenants. We also added a PCP, which was, as you know, important as a gatekeeper. And when we closed on the acquisitions, we were already on paper fully leased. So the building currently, the equity in this building is 50% Sphere principal and 50% the main physicians who are also tenants in the building, right? And we have created a very solid ecosystem for the physicians with a lot of referrals, great one-stop shop for the patient. But as you can imagine, a spectacular operations and investment for us. So we have had this assets in our books since 2018. It took us about a year to totally refurbish, so it was cash flowing since 2019. We had the first loan in place. We just refinanced, and our idea, obviously, we love that particular building, but what we decided in order to test the waters in this new venture with PropelX is to give that opportunity to investors. So what we are willing to do is to recapitalize that transaction. So we have, as you can, you have maybe been able to see, we have a purchase price, which we believe is a fair purchase price today that we would be able to obtain if we were to sell this building in the marketplace. And we are willing to recapitalize. We're going to need at least a minimum of 50%, right? So we could stay in these transactions. And when I say we, it's a combination of the current ownership. It's Sphere and the physician, which is always important, as you can imagine. If a physician with a tenant is also part of the ownership, you have an extra level of security in making sure that they are paying the rent on time and obviously taking care of the property. So the idea is to recapitalize, and we would go, as I mentioned, from 50%, not less, because it really would not be suitable for this investment, but from 50% up to whatever, 10%. Even if we stay with 10%, it will be the combination of us and the current tenant, current investors. So that's really the most important aspect of that transactions. Obviously, currently the cash flow that you have seen for the first few years is in place. We have leases that have been signed. We have indicated here a weighted average lease term of more than 7 years. Currently, the lease term, the average lease term is a little less than 4 years. But what we're going to do if we do these transactions, the tenant have already committed to extend. So we would extend, and the minimum would be what you have, 7.6. We believe that the tenant are going to extend with a brand new 10 years, but we didn't want to promise the 10 years. For sure, we will not do the transaction without having at least 7 years in place. And the other important aspect here, which is a question mark, but we have a lot of experience. Our loan will expire in 2028, and the idea is to refinance, and we have taken into considerations extremely conservative assumptions on the refi. As we mentioned, we own a lot of property. We are doing 3 to 4 refi every year. Our lenders in that particular case is Bank of America. We have an excellent relationship. We have refined two transactions with them. So there is, for us, there is no risk embedded in the refi. Obviously, no one has a crystal ball on where the interest rate will be. We believe that in the worst case scenario, they're going to be where we are today, hopefully in a better positions. But these are the I would say this is the only unknown today. Everything else, cash flow, occupancy 100%, never had any issue on the tenancy side. The PCP that we have today has a very large space. They want to potentially sublease. We already have in line a tenant that could take part of the space, so that could potentially change over the next few months. But it's a 100% lease, very secured. What you have here is certainty on the cash flow, and in terms of IRRs, it's based on an anticipated cap rate at exit. But in any case, this is a very solid, very consistent in terms of cash flow, and very visible in terms of the yield. So that's what I would say. Swati, any remark, any questions, Swati?
Yeah, I will just go ahead and ask some questions. So what everyone can see, what Sphere has shared is the details of what is the anticipated, what are the assumptions, sources and uses of funds, rent roll and tenancy, as well as the cash flow, and so on. So that is already shared with you all. We're happy to share more information. There's a very detailed research package also that has been shared. But so my questions are going to be quite basic because I'm not an expert at real estate. This is our first foray because I think this is a very interesting asset class. So I will ask some basic questions. Hopefully they're useful to other people as well. So Lydia, just so I understand this correctly, the equity, so the purchase price is 13.3 million and 5.9 million is the required equity. The rest is 7.4 million, which is fulfilled by debt. Yes.
Right. And the debt is a debt in place, right? So that's the exact, today is the exact balance of our debt, right? So the debt will be, since the company is in place, there is not even a need for assumptions. There is only with the lender a need to approve the transfer of the control if we sell more than 50%. But there is no change or debt or new debt in place on day one.
Understood. So there is nothing that will change except that some of the ownership will transfer from you to us, and or to our syndicate. I want to emphasize to our listeners and participants and attendees that this is a special offering that Sphere has been gracious enough to create for us because we wanted to offer a high quality asset which was already leased and where there wouldn't be risks of not having it be leased or the debt going awry and so on, sideways, etc. So this is a high quality asset offering that has been created for this audience. So thank you so much, Sphere, for that. And then just going into this a little bit more. So let's say about half the equity changes hands, that would be about $3 million, and you would stay invested you and the tenants would together stay invested in the remaining 3 million. Yes? Correct. And could you, for our audience, I'm sure there are people who are very familiar with real estate, but because I'm not, and so I assume that maybe others are not as well. Could you explain what is cap rate?
Yes, the capitalization rate is the return you would have if you were investing or acquiring this active or this asset all cash, right? So if we were to acquire the asset at $13.3 million today, all cash, with the first year net rent, you would have a 6.5% yield, right? But since we have leverage, and it's positive leverage, you generally improve your cap rate in terms of first year yield. Obviously, it depends on costs. What an investor needs to really pay attention is the level of cost in real estate transactions, right? The key for an investor, and that's why we show the entire cash flow. The key here is to look at the distributed cash flow, the real yield before tax, right? To have a good idea of the overall value of the investment, right? And obviously, risk embedded, right? Generally, those yields are adjusted to the risk, right? In that particular case, it is a great risk-adjusted return because we know that the risk is extremely minimum because we have owned it and have performed since the beginning without an issue. Even through COVID, by the way, we throughout our entire portfolio, and we have many assets that we have created the same way. We had zero issue during COVID. We had only one tenant who asked us for a 3 months postponement of payment of rent. Everybody else went through COVID without an issue. So we never had. There is one. We have one tenant in all of our portfolio currently in California who is having some issue, but are health related, and that's the only situation that we have been dealing with in terms of non-performance. So we have been very lucky, and I think it also comes from the fact that we are trying always to have our tenant involved in the ownership, which create an extra level of commitment, an extra level of protection from an investment point of view.
So just coming back to this from the investor's perspective, how much cash distribution should they expect annually? And that is this average. Sorry, go ahead, please.
No, it's the proportion of their ownership of the entire free cash flow. So the yield that is identified is whatever they're going to receive on their investment, and in amount, it's going to be in proportion of the ownership interest they have in the entire assets.
Right. So we are estimating that this could be about 6.5%. It could be plus or minus given the cash flows, but the estimate is it's going to be an average about 6.5%, right?
So remember, we know exactly what the rent is. These are absolute triple net, which means that 100% of the operating expenses are passed through. So we don't have, we have, I would say, absolute visibility. The only reason why the cash flow will be different is if a tenant default, right? If a tenant has a problem, otherwise 100% of the expenses on an absolute triple net, including capital expenditure, right? If we have tomorrow to change the roof, we can pass through 100%.
But we have further protection with the investors, with their investment in the deal also, where they're subordinate in the event of a default as well.
Got it. So, which means that the yield does vary over time as shown here, and the average yield is as shown here. So this is what is the cash yield we are expecting on an annual basis. For purposes of our audience, I want you to know that this will be distributed every quarter, right? So let's say in the first year, we have 5.7% yield. A quarter of that, 1 and some percentage points, will be distributed to you every quarter. So that is the first thing. So these are income generating properties. The second thing I wanted to understand, how should we think about the future and what the future exit price could be, Didier? So right now we are thinking we are acquiring it hypothetically at a $13.3 million price. How should we think of, how do you expect the interest rates to impact this? How interest rates will change? How should we think of the future and what the exit could be?
So before we talk about the valuation at exit, last word on the yield, right? Because you look at on the, I think it's page 6, if I'm not mistaken, if you want to.
Page 7.
It's page 6 on the yield, right? The annual yield, right? So you can see that based on the valuation, on the price, right?
Right.
At the entry. And based on the cost that you've seen, the yield will be 571 that's distributed to the investors, right? You see that the next year is 4.2. Why
Right.
do we drop? Is because our loan amortized, right? So we have an amortization, which is obviously we're going to get it back because this is not interest, but this is payment of the principal. But obviously there is less cash flow. It's not because we have more expenses or there is less rent. It's because we have a debt service which has increased due to amortizations, right? Then 2028, it's the time of refi. So when we refi, and you have the refi assumptions. When we refi, with the caveat that we are going to extend the lease, right? As I mentioned, it's going to be a minimum of 7 years of WALT. The refi will come and give us the opportunity to have at least 2 to 3 years of interest only. So with what we anticipate the interest rate to be, but being back on an interest only positions, we're going to be able to distribute a much larger yield, right? And that's really the value of those well calculated terms on the loan in order to be able to be as much as you can in a positions of interest only, because the amortizations, even on a 30 years, but generally in commercial real estate is 25-year schedule, can obviously drain part of the cash flow, right? So that's the explanation on the variability, so to speak, of the yield. On average, we feel very confident over those 5 to 7 years to have an average in excess of 6.5. So in that particular scenario, we are anticipating that this investment could have a 5-year holding period. As I mentioned, we bought it in 2018. We have kept it, right? And that's really a conversation generally with investors. We don't know what will be the situations with the fund that you're going to create, because if we have a large number of investors, I think the goal is to respect what we anticipate, which is a holding period, right? And not keep the assets longer unless the cycle is such that at the end of 5 years, if we consider that it's not the right time and the property is continuing to cash flow in, there is no reason to sell in a bad positions, right? So in this scenario, we are nonetheless anticipating a sale in order to be able to provide an idea of what the IRR is. And we know what the NOI will be. We know what obviously the rental rate will be. What we don't know is at what cap rate I will be able to sell. So I give you an example. If we had done these transactions in 2021, right? July of 2021 was probably, in the past 10 years, the higher point in the market. An opportunity like this one would have sold at a 5.5 cap. Okay, so that means that the lower the cap rate, the higher the valuation, right? It means that in 2021, an investor would have been fine to receive a 5.5 yield on an all cash transactions. Today, I think that this building is, and not the particular building, the market today has, unfortunately, because of interest rate, and you all are sophisticated investors, and today, I don't think that the market will offer 5.5, and that's why we have a price which reflects the market. What will be the cap rate in 5 or 7 years? Nobody truly knows, right? So we have maintained the cap that we have today on exit. It could be much better. It could be worse. Well, we know that if it is worse, then you don't sell. You keep the cash flow and you wait for the right time in order to sell. The problem of cycle when you sell, or problem when you're building and the cash flow you're building is of a bad quality, where you have no other options because you cannot refinance because you have a bad cash flow and the market is to the floor. And that's why you see in the market a lot of difficulty in cycle. Generally, the difficulty is when you are over leveraged, which is important to not be over leveraged. And generally, when you have a poor quality of the cash flow, right? In that particular case, this is a very, very solid cash flow and a great building in terms of its location and its quality and its purpose.
Right. And in this case, we have about 55% leverage, and you think that that's the appropriate amount of leverage, 56%.
Yes, we could. We have always been very, very conservative. We can get higher leverage, which, as you know, higher leverage will give you higher yield. But we don't think that it's. It is. I think it is our tradition and it's our policy to be very cautious on leverage.
Right. Absolutely. So what we are saying is that the exit could be sooner. It could be sooner, while we are in this interest-only period as well, but it could be longer, and it could be, and that variability depends on how the market is at that point. But given that we have been conservative on leverage, we expect that our cash flow will keep continuing. So people will keep getting yield until we sell, right? So that's the net of it here. There were some questions which our audience had sent us before, which was about refinancing, right? So could you talk a little bit about that, please?
So here we will have a refinancing event, right, at the end of our current term, which will happen in 2028, and we have to take into account assumptions on what we think the rate will be for refi. So there is never a doubt about interest only. We're going to get interest only at least 24 months. Generally, the number of years is based on your weighted average of lease. If we had 7 or 10 years, obviously, but more than 7, you can, with a 100% lease building, you can get 3 years of interest only. We will get the minimum of 2 years, which is what we took here into considerations, and the rate. So we assume here that our rate is again based on our understanding of the market. We have taken into consideration, I think, conservative assumptions on the future rate of this refi. But there is indeed an event of refi in 2 years for us because of the nature of the building. Refi are opportunities, right? We have done a lot of refinancing of buildings that we have kept in 2024, in 2025, and each time we have been able to draw equity because the valuation of the property goes up, and be in, despite the fact that interest rates have gone up, be in very decent positions because we go from generally a loan that is amortizing, so a weight on the yield, to, even if we have a higher rate, a IOs only, so we have more distribution. So the refi are generally great opportunities to either draw some cash out based on the valuation of the building. It will probably not be the case here if we have that transactions. I think the value is going to be very, very close, but we are going to have the opportunity to get into interest only, and hopefully we can get even better rate.
Thank you. Now I will turn this to the audience. If you have questions, please put them in the tab. I am happy to moderate the Q&A here. So please feel free to add your questions to the bottom of your screen. There'll be a question mark which shows where you can submit your questions. So we can keep continuing. But thank you so much, Didier, for sharing this opportunity, which is in Palm Beach, Florida, fully leased, with tenants who actually own the cash flow. So they own a piece of this transaction, which is great. We have a unique opportunity which has been made available exclusively to PropelX investors through this partnership. And thank you to Sphere, where they are happy to share a part of this transaction with us via our feeder fund. That feeder fund will have a quarterly distribution like we mentioned, we expect the average to be 6.5% over the 5-year life, 5-year holding period of this transaction. That average could be more or less as Didier described. And then there is going to be an exit at the end of the 5 years. Now, there is a question. What are the terms and conditions of the current debt, as well as what is anticipated through the investment horizon you are showing?
So it's a great question. So currently, I can give you example of what we are negotiating for refis, right? So we just signed a term sheet that was offered by Siemens, who was our lender on the loan on the refi, and we are getting a spread of 220 over Treasury. So we're going to be on that particular loan. This is for a hospital that we own in Texas. The term on the lease is 17 years, so long term on the lease. The tenant is a privately owned group by the name of Palm Health, but very, very solid $2 billion of revenue, annual revenue, and we're getting a great loan. We're going to be under 6, as I mentioned, so this is a fixed rate, and we have 3 years of IOs. It's a 5-year term. So that's where I just signed the term sheet yesterday for this refi, which will happen in September. We also did a refi of an MOB, very similar medical office building, very similar to the core, and we had a higher spread from the bank. That was Bank of America. It was a 235. So we were about 645 on that particular transaction. So today, that's what we're looking at. We are also doing brand new acquisitions. So these are not refi, and we are expecting to be in that range, right? For long-term WALT credit tenant, you're going to be under 6 today, right? For tenant that are smaller, so non-credit tenant, but with a WALT above 7, which is anyway what we do. We never buy brand new assets when we have a lower WALT. We're going to be 6.25, between 6 and 6.25 for medical office building.
Didier, just to confirm, what is the interest that we are currently paying on the loan? I think the question is, what do we expect in the future, like when we have the refinancing?
The refi, we expect to be at Treasury, right? Plus, I would say between, if the market gets back on its feet, it's going to be 200 spread, but it can be between 200 and 225. That's what I would anticipate. So where the Treasury is going to be at that time, question mark, right? But that's really that's generally the negotiations, right? It's mostly for us. It's mostly negotiating the spread in very good market dynamic where the lenders are fighting to do deals. You can get down to 175 basis point. It's not the case, right? So that's what we expect.
And currently, we are paying what interest? How much interest are we paying?
So I'm not sure. Can you ask David? Or you have it here?
Yeah. So 6.6% is the in-place fixed interest rate.
Okay, and we are advertising next year. So 6.6 is what we have in place. Remember that was a renewal that we did. When was this renewal done? Last year?
Last year, was it?
Or 2 years ago? It was last year, no?
5.
Last year. So we took a 3-year. So that was last year refi, which was the worst time to refi, right?
So we got a 6.6% interest last year. This is going to be refinanced in another 2 years time frame. In 2028 is when we need to 3 years. We need to refinance it. Yes?
That's correct.
And at that point, we expect it to be Treasury plus 200 to 225 basis points. And depending on where the treasuries are, that could change. But the expectation at the moment is, we don't know whether rates are going to, at this point, frankly, it's up in the air. The administration is hoping for a rate decline. We will see. So assuming the rate remains the same, see, I don't know that the rate is not going to go up. It's going to either they stay the same or go down. That's my expectation. So I'm not the expert at this. I don't know if you have an expectation on this, Didier.
If you look at the assumption that we took with in mind the 200 to 225 potential spread, we anticipate that the rate will be 575 in 2028, right? So that's the assumptions of interest rate, including the spread.
So to answer
So
that question,
we're optimistic in terms of the trend of the treasury.
Exactly. So hopefully that answered the question. How will the syndicate investors decide exit timing and price in the future? The syndicate will not. This is going to be a professionally managed property, which is going to be managed by Sphere Investments. And we will follow Sphere Investments when they decide to exit. So that is how it is going to be in the future. Hopefully that answers that question. But thank you so much for that question.
Maybe I'm going to add just one aspect on that. Generally, when we are going to refi, right, when we have a refi event, we always test the market softly, because if we have instead of a refi, depending obviously of the climate, if we can exit at that time, it's always a good moment, a good time to reflect, right? So we're going to test the market in 2028. If we think that we can sell and realize even better result, we would probably execute on the sell. And
Exactly.
if it's not the case, then the idea is to stick to the plan, which in that particular case, a 5-year holding strategy.
Right. So again, to emphasize that the exit could happen in 3 years, which is when we will refinance. If the exit doesn't happen, we will refinance. And if we refinance, then we could have a 5-year hold period. That's why we had said 3 to 5 year hold period in the description. If there's any other questions, please ask. Otherwise, we should move on to the fund. And I had hoped that, a description of this property would set us up for discussing the fund, which is going to be a more of a diversified. Did I stop sharing? Oh, no. Hang on, sorry. Let me share my screen. So the fund is expected to be a diversified fund for $50 million. And again, sorry, we can access the fund through this main page. As a reminder, go to propelx.com, go to real estate. Our 2 opportunities are listed right there. We'll talk about the fund now. So again, as before, the details of the fund are listed right here. This is a new fund that Sphere Investments is raising. Again, to be clear, in the past, Sphere Investments has had really larger LPs. And the LPs have been people like Fosun, which is a large conglomerate out of China, TIAA-CREF, which is a teacher's pension fund manager. Sorry, I'm not most up to speed on all these, and maybe Didier, you can describe these LPs better. But there's also Investcorp, which is a big investor out of the Middle East. So there have been big investors in big LPs, typically in Sphere's funds. We have an opportunity to participate in this fund again, and I'll let Sphere and the Sphere leadership team describe what is the opportunity that you're looking at here. Didier.
Yes, so this is the vehicle that we thought that could be great to launch, again, to give access to institutional opportunity to individual investors. And this fund is meant to grow the platform, right? It's meant exclusively to acquire new assets, where we are going to have at least 20% of the equity. So the $50 million, 20% of the $50 million will come from the platform, which is, I think, is important to keep with our spirit of principle. We're not here to collect fees, but to realize return on investment from our investment. And it is the fruit of 2 years of work for us on the strategy, where we have identified many opportunities to acquire smaller medical office buildings, so exclusively outpatient, no hospital here. It's exclusively medical office building and surgery centers that are smaller in size, but once aggregated in portfolio, could have an enormous value for institutional investors on the exit, right? So it's a short term, it's a value fund. The idea is to buy almost core plus asset, and I'll define it, but trying through the aggregation to obtain a return that are more value add type of return because of the difficulty to identify those opportunity and to aggregate. And I can speak to one particular example of an asset that we have already under contract and will be the first asset that could be owned by that particular vehicle, right? So 3 years is the goal. We give ourselves a year and a half maximum to raise and deploy the capital. The minimum of the fund before deployment will be $15 million of equity. We expect to be able to raise the $50 million within 1 year. We want to have a maximum of 2 years of deployment. So the last asset will be acquired 2 years from now. And we will, obviously, to avoid ordinary income tax, we will keep the assets under ownership for an additional 1 year from the last acquisition, if this acquisition happened 2 years from now. And the idea is immediately after, when we are in a safe fiscal time, which will be hopefully 3 years from now, to consider selling the portfolio. And hopefully we think that we can get those type of IRRs, which are in the low 20s, right? We have distributed IRRs, so fully realized, with an average of 24. So when we anticipate here IRRs, this is not, we're not trying to sell the dream here. We are always very prudent to under promise and over deliver, right? And we talk here obviously of a higher yield than the one that we are offering through an asset like the core, which is already in our control. Give you an example. We have currently, and we can, with any interested investor, we can talk in more detail about it. We already have under contract assets in Oregon, which is a portfolio of 3 medical office buildings and surgery centers. It's a sell and lease back, so it's a monetization of a local physician practice. The acquisitions is about $14 million for the 3 assets, and we are going to have a weighted average lease term of 10.5 years. So the current ownership occupy 51% of all of those assets, and will sign a 15-year lease upon acquisitions. We have a 8.3 cap rate, which is quite spectacular. These assets have been identified totally off market, and our yield on the first year, and we have already a term sheet for the debt, will be in excess of 8. Will be 8.4, and that's including the cost. What I'm telling you here is, so we are a machine to create opportunity. We will, even if the fund is not up and running, we will acquire that asset. And the idea is to transfer it to the fund when the fund is ready, to be the first asset of the fund. And we will, obviously, this will be our contribution, our equity contribution for whatever equity we will have in that particular deal. So the pipeline, and we have a page in this memorandum regarding the pipeline. We already have over $150 million of assets, and every follow-up that you see here, it's not an asset that is being marketed today by a broker, is an asset that we have already identified, negotiated. We have LOI on 4 of them. So this is really a live pipeline, and the window that you see is our dashboard on how we run our pipeline internally. And you have the diversity of where those assets are located.
So if you don't mind, sorry, Didier, I'm going to interject briefly to share a little bit of my experience when I visited your offices and why I felt that Sphere would be a fantastic partner for us. So first and foremost, like I said, the audience knows I'm not the expert at real estate by far, but I was so impressed by how Sphere runs how their decision making works, which is almost entirely data driven, which really appealed to me. They have this extensive database of all of the physicians in the US, where they track, which practices are successful. They have databases of which deals have happened, and they want to learn from every deal that went bad for other people. So they track all of these deals. There's a lot of information on not just pricing, but these healthcare based statistical areas. So HBSAs that are called, and by asset type, by deal type, by stages. So overall, I was very impressed by the whole decision making framework, which I know that Didier has been really instrumental in putting together. They also acquired a data analytics firm to actually help in their decision making. And what you see here is from this screenshot is from Sphere's data platform. And this is not just a slide that is put together. It's a screenshot from there. And these properties are live. So I just wanted to share that with our audience. But go ahead. Sorry to interject.
No, I think it's a very good point. I didn't want to insist or dwell on it, but I invite everyone here to go to our website. Unfortunately, it's not that easy to find, but if you go on the news and insight, look at the video section, and you'll see many videos that show certain specific tools, our technology, and you'll see how unique it is. It is really what has made our company extremely famous in the world of institutions. And I can tell you, with many years, I should say decades of experience, it's unmatched. There is no one in the world of healthcare or any type of real estate at the institutional level that work the way we work. But I invite you to look at some of the video, and you will be able to have a glimpse on our entire Sphere Analytics, which is an entity on itself that really works to help us to inform the strategy and make sure that we make the right decisions at every aspect of the chain here of values.
Thank you.
So the fund, to come back to the fund, I think the fund is a great opportunity for individuals that would want to maximize IRRs, right? This is and contrary to many other asset class, it's nonetheless an offering where we are not engaged in real estate development. Each time we deploy capital, we have cash flow coming in on a quarterly basis, right? So we are here trying to anticipate a value add strategy with a fairly high IRR in 3 years, but this is with cash flow being generated from day one and distributed on a quarterly basis. And as you can see, we are expecting a yield in excess of 8% on average.
So again, And there's a lot of information about Sphere. Like I had said, 10.35% annual yield, 24% realized IRR, almost 100% overall portfolio occupancy. And part of it is their data strategy. Part of it is they are quite focused on healthcare real estate and the way that they diligence their tenants. Part of it is that the tenants are participating in all of these transactions. You can look at the sponsor history. So all about Sphere. Sphere originated long back when, and has been functioning for almost 20 years now. So there's a lot of details. I want to add that Sphere did open, and we didn't talk about it at all. 4 international offices. Sphere has two offices in Spain, one in France, one in Italy. So it's really a global company, and expanding as we speak, which I have been very impressed by. I must take some lessons from you. But again, just to summarize, I wanted to emphasize a couple things. One is the timeline. So this is a short timeline fund. It has a 3 + 1 year structure. So starting in August 2025, the expectation is the funds will be raised and closed by August 2026. They will start acquiring assets almost right away because they are already under contract for the first asset. The last deployment will happen by August 2027, right? And so that would be 2 years from today. Is that right, Didier? Or 2 years from closing?
2 years from closing. But again, we will not start with less than $15 million. So closing could be upon those $15 million. So it could be in 2 or 3 months. We don't need to wait for the full $50 million to be
from the first closing. From the first
Yes.
closing. Got it. And so it's a 3 year plus 1 year strategy. So 4 years from today, we would have liquidated this fund, and the fund would shut down and all monies returned to investors. So firstly, it's a short hold period. Secondly, as per the other property that we saw, this is going to be a cash flowing fund. So there's a cash yield of, the expectation is around 7.5%, but we won't know the details. But as Didier pointed out, in the first property, in the first year itself, they're expecting more than 8% cash yield. So if all the other properties are similar, then we would have a great outcome. There's no guarantees, of course. So short hold period, cash flowing, and then the expectation is, like Didier said, it's not a pie in the sky. They have achieved 24% on average IRR over their exited properties. So their expectation is to generate about 20% IRRs. I want to highlight that this includes the yield, obviously, right? So the yield is not on top of the IRR. The IRR includes the yield. So that's it. And the minimum investment for the fund is $100,000 via our affiliated SPV. And again, the SPV will follow Sphere Investments in their strategy. It is going to be a professionally managed fund. If you have any questions, please let us know. We do have one question. Didier, are the IRR and yield numbers net of Sphere's management fees?
So the yield, yes, and the IRR is to the deal. We have indicated here the carried, so the participation to the success above a hurdle rate. And contrary to some, I should say to many, we are not getting any carried until the exit, right? So the yield, whatever the yield, if we have a yield of 9 to the deal, it is distributed pari passu to the investors. We are not taking any anticipated carried from yield, right? We distribute pari passu all of the free cash flow. At the end, when there is an exit, we do the calculation. If we have been successful, we get our carry.
Yeah, so
Generally,
sorry, go ahead.
Just to have a rule of thumb, right? When you are in carries with simple one hurdle, just one range, right? The way we have done it, the carried generally is about, I would say, 150 to 200 basis points of impact on the IRRs of the investors. So if we announce a 22 IRRs after carried, if you have generally a 20 or 25% above an 8 minimum, it will probably be no less than 200 basis points. So you're going to get, if the deal has 24, you'll probably be in 22, 50, 22, 3, right? But we can provide exact calculations if an investor is interested to see how it is calculated and what will be the impact.
I think that would be good. So to answer that question very briefly, the IRR is not net of fees and carry, but what Didier mentioned was that if they have 24% IRR, then net of fees it would likely have been 22 to 22 and a half IRR. I want to highlight here there is a hurdle rate of 8%, which means nobody gets a carry before investors get an 8% return. So that's number one. Number two, I want to highlight on the Boynton Beach property, Sphere is not taking a carry at all. So we have a management fee, which is 1.5% total, 0.5% to PropelX and 1% to Sphere. And we have a carry where of 5% only, which is 5% to PropelX and nothing to Sphere. So Sphere has waived any carry on the Palm Beach property. So that's an important point. And even the 5% that we will take only after you have made your 8% return. Important point. On the fund itself, there's a 1.5 management fee and a 25% carry. Because this is 25 and not 20, that IRR could be a little bit lower. But again, as funds go, I think anything 20% and more is very attractive. I've just seen a lot of venture funds here, and so which don't even return investor capital all of 1x, leave alone a profit. So I just feel that this is a great opportunity. Other questions? If anyone has other questions, please ask. So we are at the top of the hour and the end of the time. In fact, we've gone 9 minutes over. Thank you so much for your time. Didier, Esther, Dharma, thank you so much for your time as well. Really glad to have you here. I'm very excited about this partnership. All to our audience, everyone, please feel free to send us your questions. Sphere is happy to connect directly with you. Dharma has opened up his calendar and is willing to chat with any of our investors anytime. So please feel free to schedule a call with us or with Sphere Investments. We are very excited about this opportunity and we hope you find this exciting too. Thank you, everyone. Let's wrap up.
Thank you, everyone.
Bye, Didier. Bye, Dharma. Bye. Bye.